welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're talking about a relatively familiar topic, and that's looking at three sporting goods / outdoor retailer stocks to buy. But before we get into any of that, I want to say, remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com. Also, make sure to subscribe and leave a review wherever you happen to listen to your podcasts. So most casual investors and even not investors know about the likes of Nike and Adidas, and we've talked a lot about on this show recently over the last year, the red hot Lululemon. But today we're going to be talking about, I guess you could call them a little bit more unheralded sporting good retail stocks. And then we're going to close with a company that I've talked about a lot, but continues to be one to pay attention to because it's definitely been a win for investors so far in 2019. But we're going to start with Deckers Outdoor Corporation that trades under the ticker DECK. It is currently a Zacks rank number 2 buy, and then we're going to get into all the reasons for that. But we're going to start with a brief overview of the company and some of its recent results. So Deckers owns Teva, UGG, Sanuk, and some other brands that we'll get into as well. But overall, UGG is their big flagship brand. The company's coming off a better than projected fourth quarter of fiscal 2019. Those results came out on May 23rd, and it reported adjusted earnings of 85 cents per share, which crushed our Zacks consensus estimate that called for 10 cents per share. So a huge bottom line beat last quarter, and this was up from 50 cents per share in the year ago period. Interestingly enough, the top line fell about 1.6% during the quarter, and that was following an increase of about 8% in the year ago period. But it's worth noting that sales fell primarily due to retail store closures. And it is also worth noting that despite that top line drop off year over year, those sales came in ahead of our Zacks consensus estimates pretty easily. So bottom line beat, top line beat, even though sales were down year over year slightly. Now I want to quickly look at their full year overall, just to give investors a better sense of where the company was over the last year, and then frame it for what's expected to come down the line this year and next. So full year net sales increased 6.2% to just over $2 billion in fiscal 2019. And domestic sales were up 8.9% to about $1.3 billion. And then fiscal 2019 international sales were up 1.8%. And then UGG, as I mentioned, is their big brand still at the moment. Its full year sales were up 1.7% to about $1.5 billion. So accounting for around 75% of their revenue. And then a standout is a company called Hoka One One. They're a running shoe, trail running brand that's slowly gained steam over the last year. If you've ever seen their shoes, they're pretty noticeable in the sense that they have a very thick sole on the bottom. Just look them up. They're slowly growing. They have partnerships with up and coming Lululemon competitor called Outdoor Voices that's slowly building its store footprint throughout some hipper areas in the U.S. and in big towns, but they're in those trendy neighborhoods in Chicago and Austin and New York. And so those partnerships can really boost a company like Hoka One One or a brand. And it sounds so easy and it sounds so cliched to say it, but you get the right people wearing it, you get the right buzz on social media, and it really can grow. So last year, this brand sales were up 45% to around $223 million, and they're expecting some huge top line growth over the next year for that brand as well. So if you're thinking about investing, definitely consider looking into this Hoka One One aspect of their business, and going forward, if you're listening to any of their earnings calls, see what updates they have in terms of that, because that's where some of their growth is going to come for at least the next year or so. Then now I want to get into more of the fundamentals of the company, and we'll take a look at their outlook about why it's currently a Zacks ranked number 2 buy. So DECK's price to sales ratio right now is 2.1. That comes in above its industry's 0.84. So it's trading at 2.1 times sales, but that's coming in below Nike, which is currently trading at around 3.2. So nothing crazy in terms of its sales ratio there. And then in terms of its forward earnings, it's trading at roughly 18 times forward Zacks earning estimates at the moment, which marks a discount compared to its industry's 21 times average. But it is above its 5-year median of around 15. So its valuation picture is relatively solid at the moment, especially compared to its industry and some bigger players, say like Nike. And then looking ahead, our current Zacks consensus estimates are calling for 5% revenue growth this year. So that would come after full year growth of 6% this past year. And then for 2021, our estimates are calling for another 5% growth on top of this year's 5% growth to get to about $2.24 billion. So some stability on the top line. And then we're also calling for a slight downturn in full year earnings, but then a big bounce back in 2021 with earnings estimate, or our estimates calling for about 10% earnings growth in 2021 above our what is expected to be about 4% decline this year. And as I mentioned, though, this company has a stellar history of earnings beats. It's coming off that massive Q1 beat of 750%. It's beat over the last 4 quarters as well. And it's actually beat, I'm looking right now, it's beat way more than that, at least 2 years straight in a row. And overall, its earnings estimates have been trending up heavily over the last 3 years, and the stock price has skyrocketed accordingly. And the reason why it's currently a Zacks rank number 2 buy is that it's received a lot of upward earning estimate revision activity for its current fiscal year and as well as the next fiscal year, which is a big reason why it is currently a Zacks rank number 2 buy. And overall, the stock is up 183% in the last 3 years. This is compared to the apparel market's 20% and the S&P 500's 33%. The stock is up 18% year to date compared to the S&P 500's 10%. Shares opened up Monday at around $151 per share, which is slightly off of its 52-week intraday trading highs, and its average volume is at around 480,000 shares. So that does it for DECKs at the moment. Deckers at the moment, DACK ticker, and now we're going to move on to another company that I wouldn't say is unheralded, but it's not as big name of a company, you could say, these days in terms of Wall Street buzz, but it's also currently a Zacks rank number 2 buy, just like Deckers Outdoors, and that is Columbia Sportswear. Its stock ticker is COLM, and shares opened Monday at around $93 per share, which is just off of its 52-week highs, or just below its 52-week highs relatively. Its shares are up 70% in the last 2 years and 13% in 2019. So some of you might guess Columbia obviously owns its namesake brand. It also owns Mountain Hardwear, Sorel, and a few other brands. It competes against the North Face, which is owned by VF Corporation, trades under the ticker VFC. It's also now competing, I guess you could say, with Canada Goose, even though Canada Goose is coming in at a little bit higher price point and is trying to attract a higher end client that's maybe focused on more just not performance wear, which is Columbia is going for performance and style. Overall, its Q1 revenue was up 8% to $654.6 million, which was a new Q1 record for the company. Looking ahead to the current full year, our estimates are calling for about 8.5% top line growth to just over $3 billion. And then in the following fiscal year, we're calling for around 7% higher growth above that. So some solid top line growth expected over the next few years. And then on the bottom line, our estimates are calling for about 13.4% full year bottom line growth, and then another 11% higher growth above our current year estimate in 2020. The company is also, just like Deckers, coming off some bottom line beats. It's beaten the trailing 4 periods by an average of 82.3%. Overall, it has pretty much, it hasn't missed earnings estimates for the last 5 years. So management's pretty good at setting that right expectation and then beating it. In like all of our other companies that are Zacks rank number 1s or 2 buys, a lot of that is based on its upward earning estimate revision trends. So we've had 7 upward revisions for its current fiscal year and 6 upward revisions for 2020 over the last 60 days, with some solid overall movement in terms of the consensus estimate trending upward. And then, like Deckers, its price to sales ratio is at about 2.2 right now, which is above its industry's average, but trading below some big competitors and bigger companies in that sportswear industry like Nike. It's currently trading at just under 20 times forward earnings estimates, and this is a discount compared to its industry's about 21 times average. It's also below its own 5-year median of 21.5 and below its 5-year high of around 29. So some solid valuation there for Columbia as well. Investors should also know it's a dividend payer. It's currently paying 96 cents per share on an annualized basis, with a yield of about 1.1% at the moment. So Columbia, another company to consider in this sportswear industry at the moment. And then we're going to close with a company that I've talked about before that's certainly been one of the more interesting companies in this industry to follow over the last several years, and that is Under Armour. It is currently also a Zacks rank number 2 buy. I could get into all of the recent things that have been happening at Under Armour in terms of their sales and all of that, but I don't want to do too much of that. All you really need to know is that Under Armour is trending in a different direction than a lot of its peers like Adidas and Puma and Nike, in the sense that it's trying to zig while others zag. Everyone else is focusing on athleisure and this sort of more broad appeal of non-performance gear that you can wear everywhere, where Under Armour has kind of failed to make its way into that category. So it's gone with what it knows best, and that's that hardcore performance sportswear that they're going to try to continue to do. And then also over the last several years, they've seen a big decline in North America. The company has now reported year-over-year sales declines in 6 out of the last 7 quarters in its key North American market. So that's something to pay attention to going forward for investors for the next several years, no matter what. So if you're thinking about Under Armour, really pay attention to any updates they have on where they think they're going to be in North America. Luckily, they are growing internationally. Its sales were up 12% last quarter internationally. So good to see there. And then in terms of growth, they're trying to build up their direct consumer business. It's not been as successful as some of its peers, but overall, it still looks to be in a good place. There been a huge change in the business over the last year and a half, 2 years or so. Last quarter, their inventory decreased 24%, which is something positive for the brand. They're also trying to just lower the amount of actual products they sell, streamline their go-to-market strategy. So that's all been changing over the last year or so. And then their total debt was also down 36% last quarter. So those are some positive signs for the company going forward. And then in terms of our top and bottom line estimates, this is often can be what moves stock prices, especially in the near term. Our full year estimates are calling for 3.7% top line growth this year, and then higher, 6.2% above that in fiscal 2020. So that's a strong sign for Under Armour that some of its plans to revitalize its business and restructure its business might be paying off as we move into the next few years. And then in terms of its bottom line expansion, this is where our estimates are looking even better, and where Wall Street is probably liking what it sees in terms of Under Armour. Our current full year bottom line estimates are calling for roughly 30% growth on the bottom line to about 35 cents per share for the full year. And then we're expecting 43% growth above our current year estimate in the following year. So some huge bottom line growth for Under Armour. And then we also have a ton of positive estimate revisions for fiscal 2019 and 2020. And that is why it's currently a Zacks rank number 2 buy at the moment. So overall, its stock opened at $22.73 per share on Monday. It's down around 11% over the last 5 years. So that gives you a bigger picture of how the stock, which had been trending hugely upward for almost a decade, since 2015, things have gone in the wrong direction for Under Armour. And this compared to an industry that had climbed around 33% over the last 5 years. So they're down 11 while the industry itself was up 33%. But then, as I mentioned at the top, year to date, Under Armour stock under UAA as the ticker is up 33% compared to the S&P 500. It's 19%, and its industry's 8% average over that time period. So year to date, I quickly just have a chart in here just to give people a sense of where some of these other companies are year to date. This is as of Friday when I pulled this chart, Friday afternoon. So Adidas stock was up 38%. That was the highest in this group of sports retail brands. Lululemon was next at around 36%, then Under Armour at around 30% at that time. And then Nike was up only 4%, and overall the S&P 500 was up around 10.5% when I pulled this chart. So Adidas and Lululemon, big standouts, but Under Armour not too far behind them in terms of 2019 performance. And then, as we've talked about with the other two stocks, I quickly want to look at some valuation metrics to give anyone who's interested in buying these stocks a little bit more of a sense of its valuation picture at the moment. So UAA, only two A's. Under Armour's price to sales ratio sits at about 1.9 at the moment. Once again, above its industry's average, but below that industry standard, that industry giant of Nike at 3.2. But then in terms of earnings, forward earnings, it's trading at about 55 times forward earnings estimates at the moment, which is a huge premium compared to its industries, roughly 21 times. But it has traded as high as 97 times forward earnings in the last 5 years, with a median of 59 times forward earnings. So its valuation in terms of forward earnings is trending in the right direction. But there's definitely a lot to consider if you're thinking about buying Under Armour stock at the moment, but it's been a huge winner for investors so far in 2019. And that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.